All right, welcome everyone. How are you guys doing this evening? We're about to jump into this evening's class. I see we have a few of you here. I'm trying to give everyone else a chance to get on from the start. I know some of you are busy. I don't want to keep you waiting too long. So we're about a minute past the hour. I see Sandraka says, doing well. How are you? I'm fine. Thank you so much for asking. Um, Sandrika says, by the way, was last week's recording available regarding momentum candles? Okay, you're talking about the volume bar. Okay, so that recording should be available. I'm not sure if it has been loaded up as yet, but it should be available. Okay, you should be able to follow up with support about that one, but I believe it might be available. I'm not sure. However, the class was recorded, so it will be made available if it's not already. Okay. All right. So you guys ready? We're 2 minutes past the hour. I see people still coming in slowly but surely, but I think it's time for us to begin. So if you guys are ready, just give me a yes. Let me know that you're ready. All right. Wonderful. Okay. So this evening we'll be doing how to protect your trades at break even. Now, guys, remember, as I have it here, profit is always better than loss. Okay? So let's jump into it. Great. Now, how to protect your trades at break even. Protecting your investment it is the most important aspect of trading. Now, this is why we must always move our stops into profit the first opportunity we get. Now, saying the first opportunity we get may be, how can I say? Um, some people may think that as soon as you go into profit, you move your stop up into profit. No, that's not what I mean by the first opportunity you get. You need to understand the Elliott wave theory. Okay? So you need to get a correction, and then the next impulse must start before you move your stop into profit, okay, to break even or into a small profit. All right. So, for example, you find a completed correction when you see a volume bar followed by a correction that does not break the low of the volume bar. And Sandrika mentioned the recording regarding the momentum candles, which is the volume bar. That's what she really means. Okay. So what you're looking for is a completed correction. Then you're looking for your volume bar followed by a correction that does not break the low of the volume bar, right? Now, you must bring your stop into profit or break even once that correction breaks out, right? So once the correction that came after the volume bar breaks out, let's say you're buying, you get a volume bar, you get a correction, you get that breakout from the correction, you are going to enter the trade and move your stop up into profit. Okay? So let's go to our chart and I'll try to show you guys how we go about doing this. Okay? So let's look at this chart over here. Let me know in the chat which chart you'd like me to look at. So just let me know in the chat. Okay, someone says pound USD. All right, so let's look at pound USD. Pound USD. Now, that brings me back to a signal that I sent out on the pound USD. Okay, so let me see here. Right, I believe it was right here. We were looking for one more move up, right? So this was supposed to be 1, 2, then we got 3, 4, 5, right? So I'm looking for this to be a 5-wave move up. We can drop this down a little bit. Let's see. Yeah, so this is 1, 2. This one ended all over here. We had 3, 4, 5. This one came in 3 waves, right? So this one kind of truncated. I expected this one to be a little longer, but it did not go much further, and then it came to the downside. So this was a short wave, a truncated wave. Okay, so let's go back to the 1 hour. Good. So I'm going to use this area here because most of you knew that I was forecasting that this was going to go down. I was just looking for one more small wave up, then the drop. Right? If I go to my right pound USD, we were looking for just a small buy. Right? We're looking for this small buy to the upside. Let's see how that played out. Right? So this one, as you can see, it didn't give us this next wave up. We got an X wave. So if you look right inside there, you will see right around this area, we got an X wave. So the price did push up, but did not continue. It came, broke the low. Once it came and broke the low, we know that it's either going to be an extended correction, making an expanded flat, or this was a truncated wave to the upside, or we can also refer to it as an X, and all of this becomes part of the correction. But most likely this was a truncated wave, came back, broke the low, continued down, and that's when we got the news coming out around 2 p.m. And I think that was the US rate decision, and then the prices dropped aggressively. Okay, so we didn't get that big move to the upside that we were looking for. Well, relatively smaller compared to the rest of the move. So we didn't get that completed wave. It became an X, or a truncated wave. Okay, so 1 second, just close this out. Good. So we didn't get that next move to the upside. It just became a truncated wave, and price came, broke the low. Now, if we saw that this wave was an X and the price broke the low, or it was a truncated wave and the price came and broke the low, then we would know that the next wave down has started. As you can see inside here, we're looking for this bigger wave to the downside, right? Just looking for a small move up, then this bigger wave continued down. Now, we got this truncated wave, then the price continued down. If we had entered on the break of the low, right? So if this was where we entered on the break of the low, we would be selling into this. If we're selling into this move to the downside, this one came very aggressive because it was on the news, but just using it as an example. If we got filled, we sold into this, our stop first goes above here. And just a few ticks, a few pips, sorry, above. Let me just change the color, I'll make it red. Good, so that's going to represent our stop. So our stop goes just above the high. Why am I putting my stop just above the high? Because if the price comes back, hits the stop, it means that the move down is not coming now. We're getting a move up, right? So it could have come, hit our stop, completed the last wave up, and then drop. But if it continued moving down, in this case, this was a truncated wave, price continued moving down. When you get this correction, when the price comes down here and makes this correction, for those of you who are more on the swing trading side of things, when price makes this correction, then you'd want to move your stop down, right? So you'd want to move your stop, bring it into profit or bring it into break even. Okay, you don't have to bring it all the way down here because this correction could come a little deep before it goes down, right? So you don't want to bring it too far in because it could become deep. Now, if you get this correction and the price continues moving down, breaks the low, continues moving down, all you do is you bring your stop down. You bring your stop just above this correction because you're selling, okay? So you bring your stop just above this correction and the price continues to move down. As the price continues to move down and creates a correction, you can bring the stop down behind every correction once it breaks out of the correction. Okay, so when the price comes down, breaks the low, you can bring your stop down behind the previous correction. And that's basically how you protect your trade and move your stops into break even and even profit. Okay, any questions so far? Drop your questions in the chat box, sorry. Okay, Bella says no questions. Anyone else? All right, let's take a look at something else. S&P 500. Okay, let's see here. Okay, so this is S&P 500. We are on the 1 hour time frame. Okay, so not to go too far back into the price, let's see here. Generally, I like getting into the market around 2 a.m. Eastern Standard. Okay, so around 2 a.m., I'm looking to get into the market. And as you can see here, this is around the 2 a.m. candle open. Price moves up, then it starts to come down. This area here is where I would get my first entry, right? So this is the 3 a.m. to 4 a.m. candle. This is more like an engulfing candle, as you can see here. And if I took my entry here on the close of this candle, why would I take my entry here? For those of you who were in one of my first classes where I spoke about sniper entries, this is the move up. And at around between 2 to 3 a.m., this is when the market starts to shift. So as soon as I see that the market starts to shift, I'm looking to catch this move to the downside, right? And if you look at this, we can say 1, 2, 3, 4, 5. This is 5 waves up. So after 5 waves, it is complete. And if we use market geometry, we can look at this and say, let me see here. Let me just try to complete the waves. So this is 1, 2, 3, and this one is, we got this wave down. So this is 1, 2, 3. Let's change the color on that. Let's use yellow. Okay, so we have 1, 2, 3. So this is more of a completed correction. All right, so that's a completed correction here. Let's see. Let's use measured moves. So this wave, we're looking for a repeat of that wave. As you can see, it wasn't here. Came over here, a little shorter, right? A little shorter. And we will cover alternating waves later on as we go. This is where the wave 1 and the wave 3 might be different, or you can look at it as your A wave and your B wave, sorry, your C wave might be different from each other in terms of length and formation. That is alternating waves, okay? So when we use market geometry, we're typically looking for a projection, right, where our wave could potentially complete. In a lot of cases, it will make the exact move. In some cases, we could get a truncated wave, which is a shorter wave. We could get an alternative wave, which is a wave that is slightly built differently in terms of construction and in terms of length. Okay, so in this case, we have some sort of bigger corrective formation before getting our final wave to the upside. So this would be W, X, Y, X, Z. So this would look like this. W, X, Y, this is our X wave, and this is our Z wave here. Okay, so this would be a bigger correction, right? So this could look, if you want to use lines to compose these corrections, it could look like this, right? So this is more of some sort of flat type formation, but it is a WXYXZ pattern, which is a 5-wave corrective structure. All right. Now, most of us would not notice that this is a 5-wave corrective structure. So at the end of the 3rd wave, at the end of this structure, we're looking to go long, right? Because we would think that this correction is over at this point. So if we're going to go long at this point, what time is it? It is around 12 p.m. So in most cases, I don't like being in the market at 12 p.m. Eastern Standard. So around this time, in most cases, I'm done with the market. I'm not looking to get involved, right? So I would have been done with my trading at this time at 12 p.m. So this is not a time that I'm excited to get involved in the market. Okay, I'm more excited to get into the market around 2 a.m. Between 2 a.m., 5, 6 a.m. Around that time, I'm more interested in getting involved in the market. So this is one that I would not really be getting involved with, right? So let's see, 2 a.m. This is 2 a.m. This is the 3 to 4 a.m. candle. So this is showing me that potentially price wants to go down. So I'd be looking to get into the market around this time. And if I did not jump in right away, when I got this correction over here, let me try to make this bigger for you. When I got this corrective formation here, this is where I'm looking to get involved in the market. Okay. So if I got involved when price came down, broke the low, I would be getting involved around here. Let me just change the color. Good. So I'd be getting involved around this level. Okay. If I got involved around that level, my stop would go just above the high. All right. I'll put this in red. So my stop goes just above the high. Now, I'm looking to get out of the market by 12 p.m. Eastern Standard. Remember that. So this candle opened at 12 p.m. Eastern Standard. At that time, I am out of the market. For those of you, as I said, who came to my sniper entries class would know. So 12 p.m., I'm out of the market. If I was not out of the market at 12 p.m., when I get this red candle that opened at 1 p.m., closed at 2 p.m., I would be out of the market. Okay. So when I get an opposite candle, once it's happening between 12 to 1, 1 to 2, I am out of the market. Okay. I'm not going to stay in the market at that time. So once I'm able to get into the trade, once this entry is made, I could have brought my stop down behind this correction. This is not me bringing my stop into profit, but this is me reducing my risk. Okay, because this correction would be complete and we get a breakout, prices continuing down. Once I have maybe 1 or 2 candles breaking down, I would want to try to reduce my risk. Okay, and as price continues coming down, I did not get any proper correction to move my stop lower, but I was able to get out of the trade. And that's me as a day trader. Okay, now this is 12 p.m. As I said before, generally around 12 p.m., I'm not too excited to get back into the market unless maybe there is some sort of high impact news event coming out. Okay. And I do not advise that most of you use high impact news events to trade because it could become very, very volatile. Okay. So unless you have the correct tools for trading during high impact news events, I suggest that you stay out of it. Okay. And I'm sure that this most likely was some sort of high impact news event. All right, so price starts to move back to the upside on the completion of the correction. Now, for those of you who are good with the Elliott wave theory, you may have been able to analyze and say, okay, this is where the final wave is. On the completion of this wave, you can see that we're getting a green candle back to the upside. This candle opened at 1, closed at 2. So this is my signal to go long. So for those of you who understand sniper entries, this would have been your signal to go long. You would have been able to go long until the end of the day, which is going to be at 4 p.m. Eastern Standard approximately. So around 4 p.m. Eastern Standard, you want to be out of the market. Okay, so you would have been able to catch this quick move, get out of the market if you're looking to trade the high impact news event. Once you're out of the market around 4 p.m., you're done with your trading. If you did not exit exactly at 4 p.m., on the close of the 4 to 5 p.m. candle, once it closes red, because you're in a long setup, it closes red, you exit. Okay? So this is on the 1 hour time frame. This is where you would like to day trade, on the 1 hour time frame. Okay? Now, let's see if we can find, okay, so here we have 2 a.m. Eastern Standard, 3 a.m. At 3 a.m. we got an engulfing candle. Now this engulfing candle happening at 3 a.m. to 4 a.m. gives us a very good signal that price wants to go down. Okay, now we already had this impulse to the upside. So after getting the impulse, for those of you who understand the Elliott wave theory, we will be looking for the correction or the reversal. Okay, so with this being a red candle after a completed impulse move, and this is going to give us our signal to go short. So once you enter short on this red candle, you put your stop just above. So your stop goes just above. This is your entry here. You just put in a line here. Candle closed red, so that's your entry to go short. Right? And you're going short. You're looking to exit your position if you are using the sniper entries method. You're looking to exit your trades if the 5 to 6 p.m., sorry, 5 to 6 a.m. candle closes green, or the 6 to 7 a.m. candle closes green. So this is a 6 to 7 a.m. candle. It closed green. This is where you would want to exit your trade. Okay, so you exit your trade here. And as you can see here, the price came back and broke the low. So once the price comes back and broke the low, you could enter the trade again short. Okay, so if you entered the trade again short, this would be your entry down here. Your stop would be just above that high. Okay, so your stop goes there. And you simply just allow the price to move. And once the price is continuing to the downside, you are looking to exit your trade around 12 p.m. Eastern Standard. So if you're exiting exactly at 12 p.m. Eastern Standard, on the open of this green candle, you are out of the trade. If you saw that there was some sort of high impact news event coming out after 12 p.m. Eastern Standard, then you would wait and you'd want to exit on the close of this green candle here. So once you have a green candle from 12 to 1 or from 1 to 2, you are going to exit your trade. So right here, we got a green candle at 1. Sorry, this is from 12 to 1. So you would exit your trade on the close of this green candle. Why? This green candle is signaling to you that we are about to go into correction or reversal to the upside. Okay, so you would exit your trade. So you just lock in your profit for the day. You can walk away at that time. If you're expecting a high impact news event coming out later on, then you can wait for the news event to happen. Okay. Let me see here. Here we have, we're found ourselves in a correction at this point, right? So this is 2 a.m. Eastern Standard. This is 3 a.m. Eastern Standard. So from 3 to 4, we have a signal telling us to go short, right? So we have this candle here showing us a signal to go short. But for those of you who understand the Elliott wave theory, then you know that this is a correction. This was an impulse. This is going to be a correction. So you'd be simply, looking for the end of the correction, right? So I'm just going to use yellow lines here. So you're looking for this correction to end, right? So you mark the low, you mark the high, and this is basically just a sideways move. And you're looking to see this move complete in 3 waves. So let us see here. We got 1, we got, this is our first impulse up. We got a push down. So this is definitely 1. We got a push back up. So this is going to be another, let's see here. 1, 1, 2, 3. We got a push back up. So that's a complete correction here. Push back down. Another complete correction. Then we got a push up, right? So this is going to look like 1, 2, 3, right? So this is more of a regular flat type pattern, right? So we have a regular flat inside here. Now, once we have a regular flat, we're looking for that big move to the downside. So let's see. We got 8 to 9, 9 to 10, and then we're getting the 10 to 11 candle. We have 11 to 12. So we're looking to get back in the market if there is a high impact news event, which most likely this was as a result of a high impact news event. If we're getting a high impact news event coming out maybe around midday or 12 or 11 or 10 or whatever time, and we decide to stick around in the market after 12 p.m. Eastern Standard, here you can see the 12 to 1 p.m. Eastern Standard candle giving us a big red bar. Okay, with us getting this big red bar, this is a signal to us that we're moving to the downside. So using the sniper entries technique, this is a big red bar from 12 to 1. This would be our reason to jump into the trade. And our stop goes just above the swing. Use a red line. Our entry would be just below here at this point. And price moves to the downside. As you can see here, price moves down. You're looking to get out of the market by 4 p.m. Eastern Standard, right? So price spikes down, spikes up. This is 3 p.m. Eastern Standard. So we're not necessarily looking to exit at about 3 p.m. We're looking to exit about 4 p.m. So this is the 4 p.m. Eastern Standard candle. You would have to exit by 4 p.m. Eastern Standard and be done with your trade. Okay? If you're looking to trade the news. Let us see if we have another setup. So here we have 2 a.m. We have 3 a.m. prices coming down. This is an aggressive move to the upside. Okay, you can see that we have a volume bar here, right? So we have an aggressive move to the upside. We have a pullback. Now, this is either going to be coming to retest the low or it's going to be progressing to the upside, right? So what we normally do is we mark the low and we mark the high, right? Because remember, we're looking to get into the market around 2 a.m. Eastern Standard. So around that time, so we're looking to mark the low, mark the high. We want to see how the price is going to behave inside of this range that we're creating. Okay. So Around 2 to 3 a.m., we're looking for an entry. So since this was a pulse up, we're not going to try to sell this. We're looking for a buy because this was our first pulse to the upside. So we're looking for a buy. If we're looking for a sell, price has to break the low. Okay, so we're looking for a buy. So 2 a.m. red candle, 3 to 4 red candle, 4 to 5 red candle, 5 to 6 we get a green candle, right? So remember, between 5 and 6, 6 and 7, if you get a green candle, which is price moving in the opposite direction, so price was coming down, you get a green candle to the opposite direction around 5 to 6 or 6 to 7, you are looking to go long, right? So in a case like that, we would have entered long, put our stop just below here. All right, so the stop goes just below here. The entry would have been here. Let's change this color, make this red. So that's our stop. This is our entry. As you can see, price pulled back against us, then continued in our direction. Let's see. This is 8. This is the 9 a.m. candle actually. So this is 8 a.m. to 9. This is 9 to 10. So this around this area, 8 to 9, 9 to 10, this is another area where we're looking for an exit. All right, so this is 9 a.m. to 10. We did not get an exit at that time. This is 10 to 11. This is 11 to 12. Right? So 11 to 12, we got a red candle. With us getting that red candle, that is a signal that we need to get out of the trade. For those of us who are looking to get out of the trade by 12 o'clock, at 12 o'clock, we are done with the setup. So on the close of this candle, we would be out of the market. So we would have been able to protect the little profit that we made from this area to this area, and we're done with the trade. If we were looking at using measured moves, this would be our measured move, and this would be our target, right to this area. So once we got to this area, that's where we would have wanted to exit the trade right away. Okay, so there are different things in the market that we can use to set our profit targets, to set up our exits. We just need to make sure that we protect our trade. We don't want to get involved with a trade and not protect it, especially when you're swing trading. When you're day trading, the move is not usually very big. So in some cases, you could choose to not move your stop into break even, keep your stop where it is. But it is always wise that once you get a correction, you move your stop up. Okay, you move it up into maybe reduce your loss, your risk, or you can move into profit, or you can move to break even, just to make sure that you protect your account. Okay, because as you know, the market can get very aggressive. As you can see here, it did spike down, then went back to the upside very aggressively. So things like this can happen, causing you to get stopped out. Okay, so you need to make sure that when you enter, you know exactly where your exit is supposed to be, so that once you get to that profit target, you exit your trade. Okay, I personally prefer day trading over swing trading because I can get in, get to my profit, get out, I can go have a good night's rest. I don't have to worry about if the market changes, if it goes in the opposite direction. I will know everything throughout the course of the day. Okay, I will know exactly what played out. I won't be trading overnight. Okay, so let's take a look at another instrument. Someone said Euro NZD. Let's take a look at Euro NZD. Let's see here, where is it? There it is. Okay, Euro NZD. Did you take a trade on Euro NZD, Angelique? Angelique, are you with me? Okay, just trying to get Angelique's attention. Okay, so it looks like Angelique is not available at the moment. Okay, no problem. So let's still take a look at Euro NZD. All right. So I wanted to know who took a trade on Euro NZD. Maybe we could use an exact setup that you guys took and analyze it. See how you could have protected your trade in a situation like that. I see here Bella is asking, what are your favorite pairs? Really and truly, I don't really have any favorites when it comes to the markets. I trade basically anything. It doesn't matter to me. But as of late, I am looking more at the euro dollar US dollar pair. Okay. Because of the sniper entry technique, I'm a little bit more familiar with the European session, US session. So that's like my comfort zone. So I tend to look more at, pairs that are in the European session and US session. So Euro USD, very obvious choice. Okay. All right. So let's see here. Let's look for two. This one would be a little bit different because it's from the Asian session into the European session. Okay. But one of the things that we need to pay attention to is that the European session and US session are generally most volatile. Okay, which means you do get the bigger moves in these sessions. So let's start with the European session. So let's just look for 2 a.m. Right, so this is 2 a.m. right here. Right, I just picked a random 2 a.m. time slot. Right, so this is 2 a.m. And as you can see, the move down, if you understand the Elliott wave theory, we have impulse down, we have impulse up, 1, 2, 3. Let me just mark this up for you. We got impulse. This is a 3-wave move. This is another 3-wave move here. Just change the color, right? And this is the bigger 3-wave move here. So all of that makes up a regular flat pattern. So if I had to create a flat over it, this is the high, this is the low. Right, so this makes a regular flat pattern formation. On the completion of the regular flat pattern formation, if I get a volume bar, in this case, I'm getting a nice big volume bar coming in at 2 a.m. So 2 to 3 a.m., this one closed at 3 a.m. On the close of the 3 a.m. volume bar, I will be looking for a move that looks like this, right? I'll take that measurement and I'll project it over here. This is market geometry, okay? So I project that over here. I entered on the close of this green volume bar because we're trading on the 1 hour time frame. This is day trading, so we don't necessarily have to look for the corrections because we're just looking for a quick move. Okay, if we're swing trading, we're not necessarily looking at jumping in on the small waves, we're looking at the big waves. Okay, so we use the volume bars when we are day trading, and since we got this big volume bar coming in at 2 to 3 a.m., on the close of that bar at 3 a.m., we're looking to jump in, go long. Our stop goes just below the swing, right? Just a few pips below the swing. As we go into profit, we get a correction over here. When we get this correction over here, once we break out of that correction, our entry is going to be here. Let me just mark the entry. Okay. Good. So that's the entry. Once we break out of this correction to the upside, we will move the stop, move it up below this correction. Once we break out from the top, right? We move the stop up. So now we are at a small profit. Okay. So we're at a small profit. Once we hit our profit target, we are out of the trade. okay? Because we are expecting this wave to come back over here. So once we meet our profit target, we are done. And you can see here how we would have been able to move our stop from the low, move it up into a small profit, or even break even if we wanted to, okay? We protect our trades behind corrective formations, okay? So this created a correction. Once it breaks out of the correction, you move the stop up behind the correction because you're going long. So you move the stop up behind the correction. So the trade is being protected by the corrective formation. And once the wave is complete, you exit the trade. Okay. For those of you who are support and resistance traders, once the price comes and hits this resistance, you would want to exit the trade. So you would have been able to take a smaller move out the market. But for those of us who are more wave traders, we are going for the entire wave. We understand that it's going to be impulse. We're going to get a correction, then we're going to get another impulse. And we could also project that by measuring the first impulse and then projecting it over the second one for the second one. And as you can see here, it did give us a very, very close projection. So that's another way that we can project our waves, okay? So this is wave one of this move up, one, this is wave three, all right? Or we can say this is A and this is B and this is C. So this would be our C wave, okay? So as you can see, market geometry is very powerful as well. And being able to use market geometry to set your profit targets and being able to use the sniper entry technique to get into the market at the right time, especially if you are using the Elliott wave theory to analyze how the price is moving. In a lot of cases, corrective formations end at the times when the session starts, when the session has a break, and when another session begins. So make sure that you pay attention to these time slots. They're very, very, very important, okay? This technique, I won't necessarily look to use the sniper entry technique on the stock markets because the stock markets are a little bit different, okay? They're a little bit different. Normally it gaps a lot, so you don't really want to use it on markets that gap a lot, okay? Because you're going to be able to, you're going to be missing your entry, all right? Because it gaps. All right, let's see here. For those of you who wanted to get out of this market at 12 p.m., this is the candle that you'd be exiting on, the open of this red candle. If you are looking to exit based on the sniper entry system, this close of the red candle is where you would be exiting as well. Okay, so this would have been your next exit area, right? Now, for those of you who are looking to continue trading the sniper entry throughout the course of the day, the close of this red candle is where you're looking to go short, right? Because as you can see, this 1, 2, 3 move is complete and we're getting price moving in the opposite direction, right? We did get also a measured move. Price is moving in the opposite direction. On the close of this red bar, which is from 12 to 1, you enter short right here. And if you entered short right here, that's your entry. Your stop goes just above the high. And let's see here, this is you're gonna look to exit this trade at about 4 p.m. Eastern Standard, right? So let's see here. This is 4 p.m. Eastern Standard. This is the open of this red bar, which is at 4 p.m. Eastern Standard. So around that time, you're looking to exit. So we did not catch much of a move on this move to the downside because we're looking to get out of the trade by the end of the day, right? So around 4 p.m., we're looking to get out. Okay, so the rest of the move happened mostly overnight. And as you know, we're not looking to trade, overnight. All right. Those who are swing trading would be the ones involved in the overnight trade. All right. We're looking to get back in the market around 2 a.m. Eastern Standard. So this is the 2 a.m. candle. We have a big red bar at 2 to 3. Then we have a big green bar at 3 to 4, right? We need to understand what's happening in this area. So if this is most likely 1, 2, 3, 4, this is 5, we are thinking that this is going to be a 5-wave move down, and then we're going to expect that maybe we're going to get a move to the upside. Okay, so if we got a 5-wave move up, we're going to get a corrective move, which is A, B, C, right? So if this is going to be a pulse to the upside, after this is 5, we know that what's coming is a correction. So we won't be too excited to jump into this because we're expecting more of a B wave, right? Which is a 3-wave move. And if you look at the way how this is constructed, this is the volume bar. It comes down, breaks the low, right? So this is W, X, Y, right? So that's our 3-wave corrective move after this 5-wave move down. We can label this A, B, C, right? But this is most likely a W, X, Y. This is a flat pattern formation. If you look at this, draw a line here, you can see clearly that this is a flat pattern formation. And what type of flat pattern is this? This is an expanded flat pattern formation. It broke the low, broke the high. Okay, after it breaks the high, you expect the price to continue down. And when you're expecting the price to continue down, you can use market geometry. You can project the distance, and you can use that as your profit target, as you see here, right? So when are we getting this next move to the downside? Let's check the time. This is coming in at around the close of the day, right? So we generally don't want to get in at around the close of the day. But as you can see here, if we did jump in around the close of the day, you can still see the prices moving very, very well to the downside. So we need to understand when the market shifts. Once the market shifts, we are looking to get into a trade if we're using the sniper entry method. All right. So it's more of a simple way to get involved with the market if you don't understand the Elliott wave theory. Okay, it's a very simple way to get into the market if you don't understand the Elliott wave theory. You just need to understand that once you're in a trade, you need to make sure that you protect your trades. So once you get a correction, you are going to move your stop behind that correction. Okay, let us see if we can look at something that is more of a swing trade type setup. All right, so if we're looking to swing this, let us see here. So the market's coming down, right? So the market's coming down, and let's say we're looking to buy this to the upside, and we're looking to buy this. We're looking at this move to the downside. Let's see here. 1 second. Let me just try to analyze this. Okay. Okay, so this is a very complex pattern formation. So what we can do, just to simplify this, is just bring a trend line over it, like that. Okay, so we bring a trend line over it, create our channel like that, and we can see that this is price sliding to the downside, right? So what we're gonna do is look for a breakout of this. So with us getting a breakout of this, this is more like an ending diagonal type formation. Let's see, 1, 2, 3, 4, 5, makes a move down, continues up. So this is more of an ending diagonal type formation, right? So with us getting this ending diagonal type formation, you look for a breakout of this diagonal formation to the upside. So once you get price breaking out to the upside, you're looking to go long. So let's see, when are we going to look to enter? Okay, so we don't have a good entry here until around this area, right? So this is 2. We're not looking to go long. So 2 to 3, we're not looking to go long. Why? Because we can see this as an impulse to the upside. So we have to expect that we'll get a correction. Okay, so this move is already over. So we're not even going to bother getting involved in this trade because we already have an impulse. If we had a correction, then we could look to get involved in the trade, right? So we had an impulse over here. We're not going to get involved. So we have 5 to 6, 6 to 7, and at 7 o'clock we have this green bar. So we're not going to be entering at 7 to 8. So we have 8 to 9 going red. So the 8 to 9 o'clock candle, we can look to go short on that one, right? Because this is the end of this impulse to the upside. So we could expect that price could potentially fall. Now, if we enter at 8 to 9, we go short. We're looking to exit the market by around 12 o'clock. So by the close of the 12 o'clock candle, we are going to exit the market. Okay, so we exit, we're done for the day. All right. For those of you who want to remain in the market, then you can look for another entry. Okay, so you have 1 to 2. The 1 to 2 o'clock candle is green. You can look to go long again. All right, if you go long again, your stop will go at the swing low. So your stop will go below here. All right, so you put your stop just below. And this is your entry right here. Make this green. That's your entry. Good. So that's your, let me just change the color. It's too green, it's too light. Let's use yellow. Good. So this would have been your entry. This is your stop down here. You're looking to see how far the price is going to move to the upside. And you need to be out of the trade by the end of the day. So by the open of the 4 a.m. candle, sorry, 4 p.m. candle, you will exit your trade. So you went long, you exit right at 4 p.m. Okay, so at this time, you're out of the market. Why? Because we don't want to hold trades overnight. We want to get out of the market at around 4 p.m. for sure. And the best exit time is 12 p.m. Eastern Standard. But for those who would like to trade until the end of the day, 4 p.m. Eastern Standard is the next best time to make sure that you're out of the market as a day trader. Okay. You know, not in every case you'll be able to protect your account in terms of protecting your trade at break even or protecting your trade at a small profit, because in some cases the market doesn't move far enough to give you an opportunity to protect your trade. Okay, so once it gives you an opportunity to protect your trade, you make sure that you protect it. So you will be able to protect your trade once you get an impulse. So if we had gotten an impulse move to the upside after a correction, then yes, you would have been able to move your stop up. But in this case, we did not have an opportunity to move our stop up. Okay. If we were swing trading this move to the upside and we entered around here, our stop is here, we would be looking at this level, right? So this is the level we'd be looking at. And this would be all part of the correction. So if we're looking at this as a correction, we would look at this like this. This would be 1. So W. This is 1, this is 1, 2, 3. This is a corrective formation here. This is the complete wave, and this is the next wave down. So this, as you can see, 1, 2, 3. Okay, we did not hit the stop in this case. Why? This is a running flat formation. So it didn't come back to break the low. If it had come back and break the low, we would be stopped out because we entered somewhere here. Okay. So if we did not come back to break the low, as you can see, we did not come back, break the low. We're still in this trade. Price continues making a move to the upside. When price breaks the high of this correction, that's when you'd be looking to move your stop. But in this case, as you can see, our stop is already at a point where it needs to be placed, because we're not going to bring our stop into this correction. The price can always come back into the correction. Okay, so as you can see here, we break out of the correction, we make another corrective move. So let's see. We make another corrective move like this. Right, so 1, 2, 3, we have another corrective move. At that point, when price breaks out of this corrective move, if we want, we can move our stop. Right, so we could move the stop behind the correction here, right? Just to reduce our risk. So we're very close to break even, but we're not exactly at break even, okay? And once price breaks out of the correction, continues moving up, then when we get to a high enough level, as you can see, we have another correction here. We have another correction over here. As you can see, this is 1, 2, 3. So that's another correction. This gives us another opportunity to move our stop up when the price breaks out of that correction, because we're expecting price to continue up. This is another correction over here, 1, 2, 3. So this gives us another opportunity to move our stop, right? So this is the next low here. So this, once price breaks out of that correction, another opportunity to move our stop below that correction. Okay, price moves to the upside, and we continue following price until we get to our profit target. Once we get to our profit target, we are out of the trade. Okay. Any questions so far? Let me see here. Bella's asking, do you teach on the 1 to 3% risk management and how to apply to day trading? When we're trading, we need to make sure that we risk 1 to 3% of our account. Now, some traders don't follow that risk management rule, but it is actually the best risk management rule to have. So you need to understand the size of your account. Once you understand the size of your account, then you would take into consideration where you place your stop. So your stop is what has to carry the value of 1 to 3% of your account. Okay, so once the stop carries a value of 1 to 3% of your account, you're good, because if the price moves against you, you lose 1 to 3% of your account. Okay, let's see here. Robert says, this is great. Have plenty to learn, but thanks to the value added. You're most welcome, Robert. Let's see here. I see Bella's asking, that's not a wave 5. Is it WXY, or did she mean WXYXZ? Okay, which area do you mean, Bella? Are we still speaking about the Euro NZD? Yes. Which area do you speak about? Right in this area here, right here? 31st? Okay, so this area, no. This area here is not a WXYXZ formation. Why is it not a WXYXZ formation? It is simply because this is one wave down, right? Okay, look at this. If you look at this, you got 1, 2, 3, 4, 5, right? So you got 5 waves up, okay? So once we get this 5 waves up, this is our first impulse to the upside. We get 1 wave down, get 1, 2, 3, right? Let me just try to mark off these internal waves for you. 1, 2, 3. Okay, let's make this a different color. So you can see this is impulse, 1, 2, 3, correction, impulse, right? If you want to use market geometry, if you measure this one, take it, project it over here, measured move. See that? So that helps you to know that, this wave is part of this entire move. So this is going to be wave one, wave two, this is wave three. You have a complete corrective formation, right? After finding that wave, you need to find this one, which is now the wave one, which is maybe you could call it the A wave or the W wave. Okay, so you measure that wave and you can use market geometry to project where that wave is going to fall. So from the end of this previous wave, you project it to the downside. And as you can see, here you go, exact wave measurement. Okay, so when this wave comes down, makes that measurement, you know that the correction is now over because now you have 1, 2, 3. The correction is done. Now you're looking for a move up. You're looking for a reason to buy this. Okay, if you're using sniper entries, you know that you're looking at 2 a.m. to 3 for a signal to get in. You're looking at 3 to 4 for a signal to get in. You're looking at 5 to 6 for a signal to get in. You're looking at 6 to 7 for a signal to get in. You're looking at 8 to 9 for a signal to get in. So remember 6 to 7, this one is actually opening at 7. So 6 to 7 would be here. It is still short. So this one is 7 to 8. So this is 8 to 9. So the 8 to 9 candle is red. You're not going to look to jump into that move because you can see that this is a complete corrective formation or upside. So you're looking for a reason to go long, right? Excuse me. You have the 9 to 10. Now this 9 to 10 is the one that actually made the measured move. This 9 to 10 here. This is the candle that actually made the measured move, and this is the candle that is green. So we are looking to go long because this is an impulse. This is a correction. We're expecting another impulse up. We can use market geometry again. Measure this impulse, project it like that, bring it over here. This is where that wave started, and you project it to the upside like this. So this is our profit target up here, right? So you got this 9 to 10 candle as a green candle. This is where you want to go long. So you go long on the close of the 9 to 10 candle. Let's just put in a little line here just to mark this as an entry. I'll use, let's use this green. Good, so this is our entry. Where does our stop go? Our stop goes just below, right? So just below. All right, so our stop goes there. I'll put in red. This is where our stop goes. We are entered to go long. And if we're swing trading, we're not necessarily looking to exit our trade until we get to our profit target, right? So we're going to hold on to our trade. Price starts to go up. As you can see, it's going up very choppy, very corrective. So this would be our first correction over here. All right, so that's our first corrective formation. Just where we went up, we came back to our entry area, and we're moving up again. We break out. We can't bring our stop. We can't bring our stop up really. We could, but it won't be going very far. It goes just below this correction, right? So it doesn't make much of a difference, but you could move it if you'd like. And we continue to the upside. Okay, so this is another corrective formation here. It's a very small one, but it's another corrective formation. So in a case like that, you could move your stop just below that corrective formation. Okay, so price moves up to this level. And once the price moves up to this level, as you can see, it creates a bigger pullback, right? So in a case like this, if you have a reason to exit, you can. If you don't have a reason to exit, you would want to hold. So if the price pulls back against you, as you can see here, hits your stop, you are out of the trade, you made a small profit, you did not make a loss. Okay? And as you can see, the price just made a bigger correction here to continue to the upside. Okay? All right. Any questions? Any comments? Anything you're not too clear on? Anyone? Feel free, ask all the questions you'd like. I see Sandrika says, great class. You're most welcome, Sandrika. Bella says, great class as well. Thank you so much, Bella. Let's see here. Bella says, appreciate your time. You're most welcome. Anyone else? Okay, I see Grace says, it's really great info. Thank you. You're most welcome, Grace. Let's see here. Sandrika says, need to study the Elliott wave more. Yes, the Elliott wave is very, very, very important. Stephen asked, will I be able to access the recording? Yes, a recording is in progress, so you will be able to access the recording. Okay, so the Elliott wave theory is very powerful. I am looking to see how I can simplify it as much as possible by creating measured moves, by creating the sniper entry technique, by even trying to automate the sniper entry technique, because a lot of traders may have difficulty applying and moving, changing with the candlestick formations and patterns. So by automating the sniper entry technique, it makes it a lot more simple. So all you need to do is look for your exits. Okay. So hopefully soon I may bring this to unit of prosperity as well. Okay, so we'll see how that goes. All right. Okay, guys, thank you so much for your time. It's been a pleasure having you once again. I'll see you in our next class. Let's see here. Grace says, Elliott wave is the highs and lows and counting. Irony, understand fully, but learning. Okay, okay, no problem. So over time, Grace, you will understand. The Elliott wave theory is something that grows on you. It is not something that you may understand in one day or in one session. It takes a lot of time to, be able to look at a chart and just see what it's doing. Also, the Elliott wave theory comes with X waves and truncated waves. And these are the most troublesome waves in the Elliott wave theory. The market makers use them to trap you, okay? And we're not always able to see them coming, okay? The only way that we can see them coming is when the low of that wave is broken or the high of that wave is broken, okay? So let's say the price is supposed to be moving up and the wave starts to the upside, but price comes back, breaks the low of that wave. It tells us once it does not complete the move that it's an X or a truncated wave. And so we should look to go in the opposite direction, okay? Because the wave up would be complete. So you go for the next wave, okay? But in a lot of cases, we're not fast enough to catch that. So having strategies automated makes it a lot more simple. Okay, so we're looking to simplify it as much as possible for you, bring you guys some great tools and resources to help you along your journey. Okay, so thanks again, guys, for coming. I will see you guys on our next class. Bye bye for now. Have a wonderful day. Bye bye.